So in today's video, we're going to be looking at some of the hidden gems and best investment opportunities for the coming decade of the 2020s. We're going to be taking a look at the absolute exponential growth in technology and some of the industries and subsectors within technology that we think will continue to outperform in the coming decade. Some of these industries will be things like artificial intelligence, 5G stocks, computer chips. We're going to be looking at what a world full of electric vehicles will look like for different subsectors and commodities. We're going to look at the rise of automation, 3D printing, all sorts of little future trends that we're looking at that are playing out that may be significantly underpriced at the moment because most people aren't looking for these future trends to emerge. So as investors and people looking to put capital to use to make some serious returns, that is exactly what we want. We want to be looking at sectors and asset classes that are significantly mispriced and undervalued because the mainstream media or the masses haven't come to that asset class yet. Okay, that's the fundamental of investing: buying when something's cheap and selling when it's expensive. Now, in today's video, we won't have a chance to look at all of the investment opportunities that I'm looking at the moment, but we're going to briefly touch on gold, silver. We're going to whiz through a few of the charts of the gold and silver mining companies such as GDX, GDXJ, SILJ, etc. We're going to also briefly touch on a few companies and commodities that look to benefit from this push towards renewable energies and especially electric vehicles, because when you're seeing headlines such as this, UK drivers are being bribed £6,000 to ditch their diesel and oil cars to go and buy themselves a nice new electric vehicle. And you're also seeing the World Economic Forum come out and push their Great Reset agenda, which isn't just climate change based, but it's also very economic. But over here, they're always pushing that this Great Reset should be based on renewable energy and leaving energy sources such as fossil fuels and oil behind. And then you're also seeing, just a little sidebar while we're talking about the World Economic Forum, you're seeing economists from the United Nations saying that a climate change lockdown could be a good idea or necessary for the health of the planet. Just let that one sink in for a minute, guys. They're saying that lockdowns are going to be good for climate change. They're going to lock you in your house because apparently it's too dangerous to go and drive your car anymore. Let that one sink in. But we won't go down that rabbit hole in today's video, guys. We don't have time for that. We're going to jump over and have a look at the gold charts. As we've talked about on the channel many times, gold is my largest position out of anything, my gold and my silver positions, because they benefit very well in stock in times of inflation. Sorry, guys. As you can see, the last two massive bull markets we had in gold, it appreciated 1,300% back in the 1970s. 1,300%. That's a 13x on your money. And then in the early 2000s, where we went through quantitative easing and printing money, you got a massive 800% increase in gold, and they were both massive bull runs over the span of 10 years. And that is what I believe we are in at the moment in gold. Since we broke out of this bear market in early 2019, we have only just begun our next bull market in gold. And as you can see, guys, you get lots of corrections along the way, same as any market. I'm just going to highlight all the corrections we had in the gold market back in the 2000 to 2010 bull market, okay, where the price of gold ran from $300 all the way up to $1,900. So you got a 6 to 7x on your money. But along the way, you get lots of these corrections, 25%, 35%, 15% corrections or crashes in the gold price along the way. And as you can see, guys, we've just had our first correction in the gold price of 2020 in what I think is going to be a long 5 to 10 year bull market. That's why gold and silver is my biggest position in my portfolio. because I think it's going to be one of the best performing asset classes over the next 5 to 10 years. But I've covered gold in a lot of detail on this channel, so go and check out previous videos where we look at gold in much more detail. Okay, guys. But we're going to move on here to silver. Same thing. In an inflationary environment, silver performs very well. In the years 2000 to 2010, where gold had its last massive bull market, silver also rallied hard. Okay, it ran from $5 all the way to $50. So silver's a smaller market than gold, and it typically follows gold. Okay, so when gold rallies, silver rallies with it, but it's more volatile. Okay, it's a higher beta asset class. It's much smaller. So this is just another chart of gold price in the S&P 500, and as you can see, guys, when we broke the 200-week moving average back in, I think, 2001, that was a factor that initiated that 10-year bull market that we keep talking about, where the price of gold absolutely exploded on that 700% rally. So when you break above that 200-week moving average, you can see it initiates a bull market. And when we take a little bit of a closer look to where we are at the moment in this gold bull market, you guys can see we have just broken out above that 200-week moving average, indicating we've probably just begun this gold bull market. And now we're looking at silver. Again, as you can see, guys, silver is the same as gold. It follows gold, but it's typically more volatile. You've just had a nice 25% correction in the silver price. Great opportunity to get in because we are long-term macro bulls on silver and gold. Okay, they're my largest positions, and it's very common for you to get these corrections in a bull market, as we touched on earlier with gold. So now we're going to be moving on to having a look at copper. And as you can see, copper as well is another commodity that will benefit from the rise of electric vehicles, and also from infrastructure spending that is going to have to, governments are going to have to spend a lot of money on infrastructure bills and trying to keep this Ponzi scheme of a financial system looking as if it's got legs. Okay, in economic depressions or recessions, governments will spend a lot of money devaluing the currency, which benefits gold and silver, but they'll spend a lot of money trying to get the economy moving again, to creating jobs. This will be building bridges, building buildings, all sorts of things, but copper benefits from all of this, guys, and copper also benefits from the rise of electric vehicles, which seem to be pushed very hard for it's been pushed very hard because of so-called climate change. We won't get into the global agenda in today's video. We're just going to have a look at the facts, okay? So as you can see, if the world was transitioned from petrol-consuming cars to a world that operated on a 100% electric vehicle world, this chart shows which commodities will benefit from this transition and a push for the renewable green future. Sorry, guys. Lithium, you would have to see a nearly 3,000% increase in demand for lithium. Cobalt, 1,900% demand for cobalt. So we're going to be looking at lots of commodity ETFs and companies that produce lithium, cobalt, your rare earths, and these kind of commodities, because they're going to benefit significantly from the rise in demand for these commodities. Another one that I like to look at as well is uranium as well. It currently provides somewhere between 3 and 5% of the total global energy supply, and since that the nuclear explosion in Japan, I think it was the Fukushima nuclear energy plant back here in 2011, you can see it ended the uranium bull market as they tried to demonize nuclear energy. So that's why uranium, the price of uranium, and has been in a long-term decline here for the previous 10 to 15 years. But the rise in demand for uranium is only increasing, and there's a lot of power plants actually coming back online because it's a cleaner alternative to provide energy than coal is. So we're looking at the chart of the electricity around the world. And as you can see, coal produces around 9 to 10% of the global energy around the world. And with this whole push to find renewable energy and demonizing fossil fuels, I personally expect uranium to benefit from this, because a lot of power plants are coming back online. We're getting lots of new agreements from countries around the world, such as USA, France, even Japan. They're all bringing their nuclear energy plants back online. So there was actually a shortage in the price of uranium, the demand of uranium, before 2020. But when 2020 came along and the so-called health situation shut down a lot of businesses, the two largest producers of uranium around the world, Kazatomprom and I think it's Cameco, they produce 40% of the world's uranium. They shut their doors for 6 to 7 weeks. So that was a massive shock on the demand side of uranium in a market that was already very constrained. So as you can see, guys, uranium had the classic Corona crash, along with all the stock markets around the world. Everything crashed in a liquidity event, but it's recovered very nicely, and I think it's broken out of this long-term trend line, and I think it's going to potentially it could go on a very big bull market, guys. You can see where the uranium price was before that Japanese nuclear plant blew up. Okay, we're going to be moving on here to... So while we're still on the uranium chart, I just want to highlight how undervalued it is. And if we were to return anywhere back to the previous levels of uranium use back in 2011, as you can see, guys, this is a ETF, URA, which covers a lot of the uranium miners around the world. And we're currently, have a look at how low we are. We're currently 11 or 12. Back in the uranium bull market of the early 2010s, before Fukushima blew up, this ETF was valued at around 130 or 140 level. So that shows a 13 or 14 X on your money if we were to return back to previous levels of uranium usage, which it looks as if that trend is turning around, guys. So that's what we like to look for in investment opportunities. We want to find investments that have a lot of asymmetry, or a lot of potential upside and very little potential downside. Okay, we want to buy things when they're cheap, sell them when they're expensive. And now we're having a look at how early we are in the gold bull market. So as you can see, we touched on all the time the previous gold bull markets. In the black is the 2000 to 2012 bull market, where we rallied 700% over 10 years. And look at how early we are in this current bull market. It has only just begun, guys. I think we are very early in this gold and silver bull market. And as you can see, guys, this first correction that we've got in the gold price over the previous 2 months now, that the price of gold has been correcting along with the stock market. This is a great opportunity to get in a position, because I believe we're in a long 5 to 10 year bull market in commodities and metals such as gold and silver. So buy the dip. And while we're on the topic of gold and silver, let's have a look at the SILJ index. This is an index that tracks all the silver junior miners. This is one I keep an eye on pretty regularly, guys. And as you can see, since gold initiated its bull run in 2019, the miners have performed very well. Okay, we're up significantly from the March lows earlier this year. Just from the March lows, the silver miners are up 200%. Okay, they've nearly tripled. That's absurd. And even if you take the same reading from mid 2019, up 115%. So we're not cherry picking. We're not just cherry picking data from the bottom of the March crash. The miners have been one of the best performing asset classes of the previous year or so. because they give you leverage to the price of gold and silver when they're in a bull market. Okay, it makes sense. If the price of gold and silver is going up, then the companies that dig the gold and silver out of the ground, they're now selling that gold and silver at a much higher price. Okay, while their costs remain the same. Their profit margins increase significantly, and as you can see, a rising gold and silver price is very bullish for the gold and silver miners. This one here is the GDX, so this covers, it's an ETF that covers most of the major gold mining companies. As you can see, where we are today, since mid 2019, we're up 92%. Okay, the index has nearly doubled. And as you can see, it's just gone for a nice correction. This here is your Corona crash low, where all stocks got sold off. You had a nice run up, followed by correction. Very normal in price action, guys. And then you had another very nice run up into August, and we've just had a nice correction. I'm personally waiting for a little breakout from this consolidation range before I put a bit of a shorter term trade on. But that trading is not the game, guys. We don't want to trade. That's just gambling. We want to be long-term investors. Okay guys, so that video was a little bit all over the place, so I'm just going to wrap this up with some key takeaways. So gold is in a long-term bull market. I expect it to be one of the best performing assets over the coming decade. Now we've got a lot of so-called smart economists and macro investors saying that this recent 10-15% pullback in the price of gold is a top and we're now going into a bear market. They are wrong. Have the central banks raised interest rates? No. Are the central banks going to stop printing money? No. Have the central banks dealt with the $300 trillion of debt? No. Gold is in a long-term bull market, and the amount of money the central banks are going to have to print in the coming decade is going to absolutely knock the socks off some of these so-called smart investors. It's going to be in the range of tens to trillions. Okay, guys? Now, this is just another chart of all the gold bull markets. When you have a gold bull market, you really get a big one, a 500 to 600% return in the price of gold, and I think we're going to see prices, you could see a $10,000 US price of gold by the end of the decade. Okay, so that's takeaway number one. Gold and silver and the mining companies, GDX and the silver mining companies will perform great. Takeaway number two, we're getting a push to renewable energy, and as we looked at, if you had a world of 100% electric vehicles, lithium demand would go up 2,900%, guys. That's a 29x demand in lithium. And this is an ETF here called LIT. It covers a lot of the major lithium battery companies around the world. And as you can see, when it broke out in 2019, the trend is up. Just ignore the stock market crash here in March. All assets got sold off steeply, but have a look at it from its longer term trend since 2019. This ETF is up 83% as people are looking for cleaner alternatives in this push for renewable energy. Another industry that's going to benefit from the push for renewable energy, this is our takeaway number three. Copper producing companies are going to do very well. China is hoarding 80% of the world's copper supplies, and they are buying it hand over fist, getting rid of this fake paper money and trying to buy real commodities such as gold and copper. This is going to be a long-term commodities bull market as central banks devalue the currency. Takeaway number four, uranium is significantly undervalued, and we could be on the cusp of a multi-year bull market as we also look for that renewable energy push and a push to find cleaner energy alternatives as opposed to your oil and your fossil fuel and all that good stuff. So that'll conclude our first video where we look at some of the best investment opportunities that I see coming in the decade of the 2020s. Stay tuned for the next video where we go through and we have a look at the more exciting and innovative opportunities in the world of technology, and we'll have a look at all the computer chips, artificial intelligence, 3D printing, electric vehicles, and so much more. So stay tuned for that one, guys. See you in the next video.